Hello guys, welcome back to AK Trades. As part of my objective to aid ICT traders in simplifying the various ICT concepts into a simple and workable strategy. Today, what I seek to cover in my trading strategy is how to trade the 4-hour expansion candle on the 15-minute chart and how I manage my trading psychology. So fasten up your seatbelts and let's get right at it. Now, in my previous lesson, I covered the EBITDA cycle and how to use the candle range theory to anticipate reversals of PDRs. In order to trade these reversals on the aligning lower time frame charts, there are certain things to consider, and these are one, the time openings. When I talk of the time openings, I'm referring to the daily and the New York 8:30 opening prices. We must also consider whether there will be high impact news in that particular day or not. Now we also consider the 4-hour expansion candles open high low close or open low high close, and we must also ensure that this aligns with the daily candles open high low close or open low high close. Now this is very essential, especially when you want to trade against the trend. For example, let's take ICT thank God it's Friday setup. We understand from that concept that, for example, if the week is bearish, you are expecting that Friday will retrace back into the weekly range, right? So if you are seeking to trade a counter trend on the 4-hour chart, you must ensure that that particular daily candle will be bullish within the weekly bearish bias. So that is it about aligning the 4-hour expansion candle with the daily candles open high low close, open low high close. Now from the 4-hour chart, you need to drop down to the aligning lower time frame and frame your market maker model entry, and then your target should be your 4-hour external range liquidity, the daily draw, or a 2RR. Now one thing we must also note is that any lower time frame chart can be used for your entries so far as MMSM stages are clear enough. So what do I mean? For the past weeks, I've been talking about me trading the weekly, the 4-hour and the 15-minute chart. Now there are times that the 15-minute chart, which I usually use as my entry model, does not provide me with a very clear market maker model. So in that case, what do? I can drop down to the 5 minutes or the 3 minute chart where the market maker model entry will be very clear enough for me to enter and then what exit my trades. So in this scenario today, we are going to consider the 15-minute market maker sell model. Now, as we discussed in my previous video with regards to candle range theory and then the reversals, here we can see that this 4-hour candle raided buy side liquidity into a 4-hour key level. Now this key level can be another block or an internal range liquidity, and then it's also formed as, or it's closed as a reversal candle. What do I mean by it's closed as a reversal candle? Now when price reacted to the 4-hour internal range liquidity or order block, what we are expecting is a reversal signature or a confirmation in the lower time frame to tell us that actually price is reversing off that particular 4-hour key level. Now this is where we drop down to a 15-minute chart and look out for what a change in state delivery to actually tell us that prices are going what lower. So prior to the news event, we can see that the New York 8:30 open candle was here. It opened right here, and then by the help of the news event, it was able to reach this buy side liquidity into the 4-hour key level, and then caused a change in state of delivery. We understand very clearly here. So as we are trading 4-hour expansion candles, now we know that this particular candle will not be raiding liquidity and then expand at the same time in this scenario. So what do? We are not looking to trade this candle, the 5 a.m. 4-hour retracement candle, but rather we are looking to trade what 9 a.m. 4-hour expansion candle. So what do? Even though this reversal signature forms, we are still not trading this yet. Now we are waiting for the 9 a.m. 4-hour expansion candle to what open, and then we trade the open, high, low, close of that particular 4-hour expansion candle. So after this change in state delivery has been formed, the 4-hour expansion candle opens here. When it opens here, what are we expecting? That's the manipulation leg or the high of the 4-hour expansion candle will be formed within the 15 minutes what change in state of delivery. Now that is what's happening here. When the 4-hour expansion candle opened, the high reacted to the 15 minutes change in state of delivery and then created an SMT with a correlated what asset. Now, after the high has been created, we are expecting to see an order block created or a key level created after the 15 minutes change state delivery has been respected. That is what we seek to capitalize on in order to trade lower. The key level that is formed after the 4-hour expansion candles high has reacted to the 15-minute change state delivery. Now, if you look at this case, this is where it's formed. So when we want to trade a 4-hour expansion candle lower, this is where I will normally set up my trade at this order block, place my stop loss at the 4-hour expansion candles high. That's reacted to the 15-minute change in state delivery and then form the SMT. I place my my stop loss over there, and I target what a 2RR or the 4-hour external range liquidity. Now, mind you, all this, if you are trading the New York 830 open price, we are expecting for we to get an opportunity within the New York kill zone. So our setup should happen within the New York kill zone. Anything beyond that, I'm not interested. Now, in this state, in this scenario, where I'll be entering will be my first stage distribution. My first stage distribution. Now, if I want, after an order block has been created after the first stage in state delivery, I can also seek to enter with my second stage redistribution. That will be my ICT silver bullet entry, targeting a 2-hour or also the 4 external range liquidity or the daily draw on liquidity. Now, this brings me to the end of my trading strategy. Within the past weeks, we've gone through the weekly charts, how I trade the weekly internal to external range liquidity. We dropped down to the 4-hour market maker model, and today we've gone through the 15-minute market maker model. That is where I seek to enter my trades for a 2-hour risk reward ratio. Now, irrespective of how good your strategy may be, there are certain factors that play significant roles in achieving success in trading. And then this brings us to your trading psychology and then your risk management. You can have the most perfect, let me put it that way, the most perfect strategy in this world. But when your emotional and mental well-being is not in the right frame, then this may affect your executions and then your trade management. Now, what are some of the key factors to consider when it comes to our trading psychology? our strategy and its win rates counts. Our risk management or trade management also is taken into consideration. Then how do you handle losses? How do you handle losses? Now, everything comes together to have an impact on your trading psychology. Now, I'll be taking them one after the other. So let's start with a strategy. A lot of traders are fond of strategy hopping. Now, what do I mean by that? They trade with a particular strategy, have one, two, three, or more of losing streaks, and that is it. They throw their hands in despair and they are like, this strategy doesn't work. Instead of them sitting down and patiently analyzing what went right or what went wrong within their strategy, they rather jump onto the next strategy. Now when you keep on doing this, you keep on roaming around for a very long time without you finding the right strategy to trade with. Because mind you, there is no perfect strategy. No matter how good a trader you are, or no matter how best strategy you have in this world, you will still have losing streaks. But does it mean when you get to losing trades, you have to jump onto the next? No. Rather sit down, go to analyze your trades and see what went wrong. Identifying those things will help you better your strategy and yourself. Now, what I also did was to backtest my strategy and then forward test it. So I believe more of the forward testing than the back testing because mostly with the back testing, it is done at hindsight, whether you like it or not. You kind of cherry pick where to apply the strategy, which in most cases doesn't help a lot because you are actually selecting grounds. Let me put it that way. So how when you come to the real trading environment, you cannot always predict what is going to happen in the future. So it makes sense to rather forward test your strategy more than to back test. And with the forward testing, what I did was to buy a challenge account to do that. Because what I also realized is that when there is no amount of money involved, you don't take your strategy seriously. You don't take trading seriously. But where there is money involved, all your mental abilities, your trading psychology, everything comes to play. Your psychology, your trade management, when there is real money involved, that is where you take everything into consideration. So I prefer forward testing rather than back testing. So my next thing I want to discuss is your risk management. Now I usually target a 2 hour as an intraday trader and then a part-time trader. So why 2 hour? I believe higher what do you call it, risk to reward ratios means a longer time for my positions towards go through, right? So if I go for a lower RR, it means it will take less time for my target to get hit. And time is very essential on my part because I have a full-time job and I don't need to spend more hours on the chart. So I enter the trade 2 hour per and I'm done for the day. That is how I trade. Now, other people also have their own way of going about their trade management. Some of them can target more than 2 hour, let's say 4 hour, but decide that okay, at 2 hour, maybe I'll take a certain percentage, whether 80%, 50%, 60%, or whatever percentage they feel comfortable. They'll take it off and allow the rest of the trade to run. But I don't actually go with that, even though sometimes I do that, but I don't prefer that because it will mean still going back to the chart at the least opportunity to see how far my trade is going. And I don't want to be in that position. So I enter the trade and then 2 hour, I'm out. I'm done for the day. Now, how do I handle my losses? So basically, I look forward to getting a maximum of two trades every day. Now, with these two trades, what I do is if my first trade is a win, then I don't take the second trade. When I get my first win, I'm done for the day. Now, if let's say I take a first trade in the lending section and I lose that trade, I'll rather wait for the New York session where the bias of the day becomes more clearer. So when I execute in the New York session, I'm expecting that I'll be able to secure a 2RR to cover up the loss I made and make an additional profit. Now, if that also doesn't go through, then that means I'm down for the day. I am not going to overtrade because it's going to have a negative impact on my psychology. I will not overtrade because that is the maximum I can handle. That is a two loss in a day. Because if I get learning session wrong and a New York session also wrong with my bias, then my problem here now is, am I really right with my weekly bias? Am I truly right with my weekly bias? So I have to go back, reassess everything, and then come back again. And I can't do that in that very day. I have to go, relax, sleep, and then come back the next day to analyze the charts. So for me, one win is enough to end my trading day to avoid over trading. And then when I lose a maximum of two trades, I am also done for the day. Now, how much do I risk per trade? So normally what I do is I risk 0.5% of my account size per trade. So I'll continue to throw with 0.5% of my account size till I reach a 1% of what profit. Now at 1% of profit, what I do is now I can risk 1% of my account size. So I'll also continue to raise the 1% till I reach the 2% of profit. Now the maximum amount of risk I can take per trade is a 2% of my account size. But that would only happen when I am in 4% or above 4% of profit. And all my target is for a 2R. So that is how I actually do it. You can also pick it up, back test or forward test with your strategy and see how it will also work for you. It has been helping me a lot. It helps me handle my trading psychology. When I even lose 0.5% in a day, I am still okay. Even if I lose 0.5 twice, that means 1% of my trading account in a day. I'm okay. That is, to me, I am okay, and it will not have any negative impact on my trading psychology. So that is how I trade, and that is how I manage my trading psychology. Now, before we come to an end of today's what section, what I want us to do is to go onto the charts and see how we can incorporate everything we've learned throughout this strategy, from the weekly internal range liquidity to external range liquidity to the 4-hour market maker model, right back into our 15-minute market maker entry, which we studied today. So here I'll use the bar replay function of TradingView, and then this is Euro USD weekly charts. And then, like I indicated in my strategy, when I open my charts, the first thing I do is to identify my dealing range on the higher time frame. So here, this is my dealing range. This is my weekly dealing range. This is my weekly dealing range. Now within this dealing range, what I do is identify my what premium and discount zones with my Fibonacci tool. So this is my discount and then a premium zone. And as we can see, market is making what? Lower lows and then lower highs. That is, we are in a bearish market. So what I'm seeking to do is to trade from internal to external range liquidity on the weekly chart. So we can see that at the premium level, there is a what? Fair value gap or internal range liquidity residing here on the weekly chart. On the weekly chart. So after we've identified our weekly PDRs, we will drop down to the 4-hour market maker model, and then from that side we are going to confirm whether price is actually reversing from the weekly internal range liquidity. So as we can see here, our previous candle's high was taken, it was raided by liquidity to a premium level. So this is our liquidity sweep here. So when we go back to the CRT reversals we learned in the previous session, you understand this model right here. So we drop down to the 4-hour chart and try to frame a market maker model on the 4-hour chart. So as we can see on the 4-hour chart here, as we can see on the 4-hour chart here, after a reaction into the weekly internal range liquidity, after price was buy side liquidity was created into the weekly internal range liquidity, you can see that there was a change in state delivery that was formed on the 4-hour chart. So price retraced back into the 4-hour change in state delivery, respecting it. So at this point, what we will do is to target what? Our 4-hour external range liquidity as our draw on liquidity from the 4-hour change in state of delivery. So from there, we will drop down to the 15-minute chart. We'll drop down to the 15-minute chart. Now, at the 15-minute chart, what do we see here? This is where price reacted to the 4-hour change in state of delivery. So let's see what happens. We are looking for a change in state delivery to form on the 15-minute chart to also confirm that price is actually retracing from our 4-hour change in state delivery. Now the 15 minutes change in state delivery hasn't been formed yet, so we wait patiently. We wait patiently. We wait patiently. And then as we can see, when price reacted to the reacted to the 4-hour change state delivery on the 15-minute chart, at this point it failed to change state, and then it went back to also react to the same 4-hour change state delivery in during the next day. Now this is what we will be considering as our change state delivery at this point. That's our 15-minute change state delivery. 15 minutes change in state of delivery. Now let's see where it occurred. Now in this case, it occurred above our daily opening price. It occurred after our daily opening price. So let's see what happened next. Now you can see that after price reacted to the 15-minute change state delivery, another block was created at this point. Now we are waiting to trade the 4-hour expansion candle, right? So this is actually the 4-hour expansion candle we are looking to trade. Now on the 15-minute chart, on the 15-minute chart, this is what we are targeting. So let's see what happens. Now, this strategy is not limited to any time frame. It is fractal. You can apply it on all time frames. Now, it doesn't also matter the session that you trade with. Setups can form in any session. It can be the Asian session, it can be the London session, it can be the New York session. Now, as we can see, the opportunity actually here is forming right in the Asian section. So, as you can see, if you are to place a trade at this order block, put our stop loss here and target the 4-hour external range liquidity. Now in this case, our RR will be 0.39, which is not ideal. But what I want us to notice here is that this is fractal and it's an okay, and no, this one should be more than 0.39. Okay, I think there is something wrong somewhere. This should be more than 0.39 RR. I don't know what the problem is, but I think this should be more than that. So let's see how it plays. We got tapped in here. Let's see whether our 4-hour external range liquidity will be taken out. Let's see what happens. Exactly. So I don't know why you're saying this is a 0.4 hour. I don't know what's wrong, but this doesn't look like 0.4 hour to me. It should be more than that. Well, let's say it's a glitch of the app or whatever. So you see, that is basically what happens with this model. As you can see, this trade went through right during the Asian session. Right during the Asian session. It can happen on all time frames. It can happen during every section. It can happen at everywhere. That is why I don't agree to the fact that certain sessions are not favorable to trade, others are more favorable than the others. If you know what you're looking for in the market, you shouldn't worry about which session the setup is forming. You shouldn't worry about which session the setup is forming. So after covering my trading strategy, now my next objective is to be providing weekly analysis on the various trades I'll be taking within the week with this exact strategy, this same strategy. So hopefully in the subsequent weeks, if only my setup forms within that particular week, and I'm looking like I said, I'm a part-time trader. There are sometimes I miss a whole lot of trades because of my work. So I'll make sure whatever trade I take within the week, whether I win or a loss, I'll come back onto the channel, make a video and explain everything. And I know that will also help me analyze my trades and see what went right and what went wrong. So thank you for sticking with me throughout this session. Good luck and stay safe.